Hey everyone, welcome to The Explainer. Today we're diving into the dense financial metrics of Portland General Electric, or PR. We're going to break down its nearly $5.8 billion market cap into a clear, structured investor scorecard. If you've been tracking the utility sector, you know it's a unique beast. It's constantly balancing massive infrastructure costs with the mandate to deliver reliable returns. So, let's cut through the noise and see exactly what's happening underneath the surface of this Pacific Northwest powerhouse. Now, if you want to understand the immediate appeal of this utility giant, you really just need to focus on one powerful number, 20. Yep, that represents 20 consecutive years of annual dividend increases. For the income-focused investor, a 2-decade streak is a massive beacon of reliability. It tells a story of a management team that is fundamentally committed to returning capital to shareholders through economic downturns, regulatory shifts, and entirely changing energy landscapes. So here's our roadmap for today. First, we'll check the current price tag. Second, the dividend engine. Third, historic growth and returns. And finally, we'll check under the hood. All right, part 1, the current price tag. Let's evaluate POR's valuation. With the current sticker price sitting right around $49.73 a share, the biggest question on everyone's mind is the stock actually cheap right now? Sure, it's down from its 52-week high, which might look like a bargain at first glance. But before we assume we're getting a discount, we need to ask if we're actually paying a premium for expected future growth, or if this price is justified by present realities. To figure that out, we've got to look at the PE ratio. That's the price to earnings to growth ratio, which basically determines the trade-off between current price, earnings, and expected growth. And, well, POR currently has a PE ratio of negative 2.09. That is an instant red flag, folks. A negative PE usually implies shrinking earnings expectations. It essentially means you might be paying more today for less growth tomorrow. And that red flag perfectly sets up our valuation dilemma. Across the board, POR is trading at a premium right now compared to its own recent history. I mean, the price-to-earnings ratio is at 18.02, price to sales is 1.62, and price to book is 1.39. All of those are sitting noticeably higher than their 3-year historical averages. So the market is pricing POR richer today than it has on average over the last 36 months, despite that concerning negative PG ratio we just looked at. Now, contrast those premium valuations against this specific number, an EPS fair value price of $39.24. When you run the discounted cash flow metrics based on earnings per share, the data actually suggests the stock could carry a negative 26.72% margin of safety at its current price near $50. Bottom line, if you are buying in right now, the math suggests you are absolutely paying a premium. Moving right along to part 2, the dividend engine. Let's analyze the income play. Let's be real for a second. The primary reason most investors flock to regulated utilities is for reliable compounding income. And if you're seeking consistent cash flow, you're definitely going to appreciate the current 4.22% dividend yield. On the surface, this yield looks incredibly well supported. The standard payout ratio sits at 76.09%. Basically, they're paying out roughly 76 cents in dividends for every dollar of standard net income they generate. In the highly predictable utility sector, that's generally considered quite safe and manageable. But hold on, because the narrative completely shifts when we look at the free cash flow payout ratio. It is hitting exactly 100%. So while the accounting earnings look totally fine on paper, the actual cash reality is way tighter. A 100% ratio means every single spare cent of unencumbered cash is being diverted just to maintain those dividends. There is literally no breathing room in the cash flow to fund new projects without taking on debt or issuing more shares. Which brings us to a massive point of tension for POR, a trailing 12-month free cash flow of negative $71 million. Yeah, you heard that right. Despite bringing in over $3.5 billion in revenue, the huge capital expenditures required to maintain and upgrade the utility grid have pushed free cash flow entirely into the red. That's driving an abysmal price-to-free cash flow ratio of negative 79.21. Essentially, they are leveraging other capital just to keep that 20-year dividend streak alive right now. So how does this play out over time? Let's jump into part 3, historic growth and returns. Given those cash flow concerns we just talked about, looking at the stock's historical track record might actually give you a little whiplash. In recent years, we've seen some severe short-term volatility. The stock dropped a painful 20% in 2020, bounced back with a massive 28% gain in 2021, and then followed that up with consecutive down years in 2022 and 2023. It's a great reminder that just because a stock is a utility doesn't magically make it immune to big market swings or shifting interest rate environments. But when we zoom out, we start to see exactly why utility investors are famously patient. By factoring in the power of compounding dividends over time, we see that total return completely smooth out that year-over-year volatility into a really reliable, steady climb. Over 3 years, you're looking at an annualized return of about 4%. Over 5 years, 4.10%. And over a 10-year horizon, investors have enjoyed a very solid 6.54% compound annual growth rate. The dividend is doing a ton of the heavy lifting here to keep total returns positive. All right, time to wrap things up with part 4, checking under the hood. Let's look at health and efficiency. To really understand the mechanics driving this entire operation, we've got to circle back to that negative cash flow we noted earlier. What is that metric actually telling us about the value proposition of our investment? Well, the standard earnings yield sits at a respectable 5.28%. But the free cash flow yield? That tells a much more cautious story about the company's financial flexibility. Just to be totally clear, free cash flow yield measures the actual cash return on your investment. It's what's left over after keeping the lights on and the infrastructure updated. POR's FCF yield currently sits at negative 1.22%, and this perfectly illustrates the built-in tension of the utility sector. You've got these incredibly heavy, unavoidable capital costs required to run a power grid and transition to clean energy, and those costs are severely restricting POR's ability to generate immediate, unencumbered cash for its shareholders today. Now, obviously, if cash flow is tight, we have to look at debt. A current debt-to-equity ratio of 1.20 shows there relies slightly more on debt than equity to fund these expansive operations. But context is everything here. That 1.20 ratio has actually improved compared to their 3-year average of 1.30. So yes, they are leveraged, but management has actually been dialing back that leverage slightly over the last few years, which is a really positive sign for their overall balance sheet stability. Let's fire through some final health checks. A current ratio of 1.08 means they can comfortably cover immediate debts, but their quick ratio is 0.95, which strips out inventory, meaning they have slightly less highly liquid cash than immediate liabilities. As for efficiency, they're generating a 2.36% return on their massive physical assets and a 7.40% return on equity. Look, these aren't explosive tech stock numbers, but rather the modest, steady efficiency metrics you'd totally expect from a highly regulated regional monopoly. Ultimately, analyzing POR leaves us staring down a classic investor dilemma. Do the immense scale, the geographic monopoly, and that incredible 2-decade track record of steady dividend growth outweigh the glaring warning signs of negative free cash flow and a premium valuation? It's a tightrope walk between guaranteed income and capital efficiency. So as you review your own portfolio, you have to ask yourself, are you simply paying a premium for safety, or are you trying to catch a falling knife that's just masked by a really reliable dividend? Thanks so much for joining me on this explainer.